and welcome back to Intelligent Investment today. In this episode, we're going to turn our attention away from equities and focus on an area of investing that is often misunderstood, oversimplified, and sometimes treated as though it is inherently safe. We are going to be talking about bonds. We have, of course, spoken about bonds on this podcast before, but in this edition, we're going to delve that little bit deeper. Now, many investors hear the word bond and assume stability, predictable income, lower risk. And while bonds can play that role in a portfolio, the reality is far more nuanced than many people realise. Because not all bonds are the same. Far from it. Some are backed by governments, others by corporations. Some are secured against valuable assets. Others are effectively unsecured promises. Some sit near the top of the repayment hierarchy. Others are dangerously close to equity in terms of risk. And when financial trouble emerges, those differences suddenly become very important. And this was something that Benjamin Graham spoke a lot about in his books. In fact, Graham took a surprisingly cautious view on bonds for the ordinary investor. He thought that if investors were going to allocate money to bonds, they should focus primarily on the safest forms available. Because once investors begin reaching for higher yields and taking on greater credit risk, Graham argued they may as well simply invest in equities instead, where at least the upside potential properly compensates for the additional risk. And today we're going to explore exactly why he thought that. We'll look again at what bonds actually are, why understanding bond structure matters, and why every investor should know exactly where they stand in the hierarchy of payment if a business fails. So without further ado, let's crack on. Sit back, tune in, and get ready to take on board another lesson in value investing as inspired by Benjamin Graham. Let's begin at the beginning. As a reminder, a bond is fundamentally a loan. When you purchase a bond, you're lending money to the issuer. That issuer might be a government, a corporation, a bank, or another institution. In return, the issuer agrees to pay interest, often called the coupon, and then repay the money in full on maturity. Now, on the surface, this arrangement appears straightforward enough. But beneath that simplicity lies enormous variation. Because bonds differ in credit quality, in maturity, in security, in priority, in covenants, and risk. This is why treating all bonds as though they belong in one uniform category can be highly misleading. A short-dated government bond issued by a financially stable country is a very different proposition from a highly leveraged corporate bond issued by a struggling business. And yet they are both still technically bonds. So one of the first lessons investors must understand is this. The word bond tells you almost nothing by itself. You must understand the structure underneath it. This is precisely where Benjamin Graham became cautious. Graham believed that many investors misunderstood the relationship between risk and reward in bond markets. A conservative government bond might produce modest returns, but it will likely offer a high degree of safety. This is perfectly acceptable if safety is the purpose of investment. But once investors move into lower quality corporate debt in pursuit of higher yields, Graham thought the equation changed. Because now investors were accepting substantial business risk without necessarily receiving equity-like upside in return. In other words, they were exposing themselves to many of the dangers associated with stocks, but with capped returns. And Graham thought that this was often an unattractive trade-off. If an investor is going to take significant corporate risk, he argued, they may as well own equity in a strong business, where they can at least participate in long-term growth and compounding. This is an incredibly important idea, because it forces investors to think carefully about what they are actually being compensated for. A slightly higher yield may not justify materially higher default risk, particularly when downside can be severe. Now, one of the most important distinctions in bond investing is between secured and unsecured debt. A secured bond is backed by specific assets. That means if the issuer fails, bondholders may have a legal claim over certain property, cash flows, or business assets. For example, a company may issue bonds secured against real estate, machinery, infrastructure, or receivables. These assets act as collateral. And this matters because it affects recovery potential if the company defaults. An unsecured bond, by contrast, has no direct claim over specific assets. The investor is relying primarily on the issuer's overall financial strength and ability to repay. Now, this does not automatically make unsecured bonds bad investments. Many financially strong businesses issue unsecured debt, but it does mean that the investor's protection is weaker if things go wrong. And this brings us to an extremely important concept in bond investing: priority of payment. When a company enters financial distress or bankruptcy, not everyone gets paid equally. There is a hierarchy. A legal order determines who gets paid first and who absorbs the losses. This hierarchy is critical because in many cases, there simply is not enough money to repay everybody in full. So where you sit in that structure can dramatically affect your outcome. At the top are usually secured creditors. These are lenders with direct claims on assets. If the company fails, they may seize or sell those assets to recover value. Below them come various forms of senior unsecured debt, then subordinate debt, and finally equity holders, the shareholders, who sit at the very bottom of the structure. This is why equity investors are often described as residual claimants. They receive whatever is left after everyone else has been paid, which in bankruptcy situations is often very little or nothing at all. Now, this hierarchy explains an important principle. Higher returns usually reflect higher risk. If a bond offers unusually high yields, investors should ask why. Very often, the answer lies in weaker protections, lower priority, or higher default risk. Let's take subordinate debt as an example. Subordinate bonds rank below senior debt in the repayment structure. This means that if the company fails, senior creditors are paid first. Only after they've recovered their claims do subordinate bondholders receive anything. Naturally, this increases risk. And because of that, subordinate bonds generally offer higher yields. Now, during stable periods, investors may focus primarily on those higher yields. But during crises, hierarchy suddenly matters enormously. Because once defaults begin occurring, investors discover whether their position is genuinely protected or not. And this is one reason why intelligent bond investing requires more than simply chasing income. Yield alone tells you very little. You must understand what risks are attached to that yield. And again, this aligns strongly with Graham's philosophy. He repeatedly warned investors against reaching for yield without fully understanding the underlying risks involved. Another critical concept is the idea of liens. A lien is essentially a legal claim against an asset. If a lender has a first lien on property or assets, they typically have the strongest claim in the event of default. Second lien lenders rank behind first lien creditors, and so on. This becomes especially important in highly leveraged businesses, because multiple creditors may all have competing claims against the same pool of assets. Now, to many retail investors, these details may sound technical or even unnecessary, but they matter greatly when things go wrong. And one of the reoccurring lessons in investing is that risk often appears low until stress emerges. During good times, weak structures can appear perfectly stable. Companies continue making payments, markets remain calm, investors collect their coupons. But financial distress exposes the true nature of the capital structure. And suddenly, legal protections, seniority, and asset coverage become critically important. This is also why bond investing requires careful credit analysis. Equity investors often focus heavily on upside potential, revenue growth, market opportunity, innovation. But bond investors must think differently. Because unlike shareholders, bondholders have limited upside. The maximum return is generally defined by the coupon and repayment terms. But the downside can still be severe if default occurs. So bond analysis is often centred around one key question. Can this borrower repay its debt under all circumstances? And that requires examining cash flows, interest coverage, debt levels, liquidity, asset values, and the overall resilience of the business model. In other words, bond investing is often more about avoiding disaster than chasing extraordinary upside. And this was central to Graham's thinking. He thought defensive investors should prioritise preservation of capital above all else when purchasing bonds. Now, another important point is that bonds can behave very differently depending on the issuer. Government bonds, for example, are often considered lower risk because governments can typically raise taxes or print currency to meet obligations, although even governments are not entirely risk-free. But corporate bonds introduce business risk. The strength of the issuer matters enormously. And then there are high-yield bonds, sometimes called junk bonds. These are bonds issued by companies with weaker credit profiles. Because the risk of default is higher, the yields tend to be higher as well. Now, this does not mean all high-yield bonds are poor investments. Some can be attractive when properly understood and priced. But investors must recognise that they are taking on greater credit risk. Again, not all bonds are equal. And Graham himself was highly sceptical of speculative bond investing for ordinary investors. His view was simple. If you're taking substantial business risk anyway, why accept limited upside? Why not own carefully selected equities instead? There is also an important behavioural lesson here. Many investors focus heavily on income. A bond yielding 8 or 10% can appear attractive compared to lower yielding alternatives. But yield can create a dangerous illusion, because investors sometimes confuse income with safety. And this is particularly risky when they do not fully understand the underlying structure. A high yield is often compensation for elevated risk. The market is rarely giving away free returns. So disciplined investors must look beyond the headline numbers. They must ask, what assets support this debt? Where does it rank? What protections exist? How resilient is the issuer? And what happens if conditions deteriorate? These questions matter far more than the coupon alone. Now, from a value investing perspective, bonds can still play an important role, particularly when markets become dislocated. There are periods when strong businesses issue debt at attractive yields because fear has distorted pricing. And in such situations, bonds may offer compelling risk-adjusted returns. But value investors approach bonds the same way they approach equities. They focus on intrinsic value, margin of safety, and downside protection. Because ultimately, investing is not simply about chasing returns. It is about understanding risk. And bond investing is, in many ways, a study of risk itself. As we come to the end of this discussion, it's worth reflecting on a broader lesson. Bonds are often presented as simple, conservative investments. But the reality is much more complex. Every bond has its own structure, its own protections, its own risks. And understanding where you stand in the hierarchy of repayment is absolutely essential. Because when businesses fail, capital structures suddenly matter enormously. The difference between secured and unsecured debt, senior and subordinate claims, first lien and second lien, can determine whether investors recover most of their capital or very little at all. And as Benjamin Graham recognised many decades ago, investors must be careful not to reach for yield without properly understanding the risks involved. Because once a bond becomes highly speculative, the distinction between debt and equity begins to blur. And at that point, investors may be accepting equity-like risks without equity-like rewards. That brings us to the end of today's episode. A closer look at bonds, credit structures, and the importance of understanding risk beneath the surface. Because in investing, appearances can be deceptive, and nowhere is that more true than in fixed income markets. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.